All right, if we want to get seated, we'll get the panel started. I was informed that we're 7 minutes late, which means we'll be 7 minutes late for lunch. So there's incentive in trying to move it forward a little bit. My name is Lars Kvale. I'm with APX. I'll be the moderator of this session. And I think for those of you who just participated in the plenary, listening to the plenary, there was a lot of discussion about the policy environment in Canada, Mexico, United States. We'll dive into a little bit more detail in each of those markets, maybe primarily Canada and United States, and touch on Mexico, but also get into some details on the pricing, some of the more recent developments, and get the perspective of some of the active participants in the markets. So I'm joined today by Bill Fletterback from Climco, President and CEO of Climco. They're one of the leading product developers. I believe we saw him get an award just a couple of minutes ago. Jean-Philippe Brisson, one of the main experts on the California carbon markets in general, with Latham Watkins, and then Jackie Cooley with ICIS, who will provide the perspective from a market analyst. And again, we'll try and dive in some of the details. We'll touch on several different items, but at first I just want to give each of the participants maybe 2 to 3 minutes to introduce themselves, the organizations, and then we'll get the discussion going. We will also, at one point, bring it out to the audience. So if you have any questions, certainly prepare those, and you can participate in the discussion. So with that, Bill, you want to go first?
Sure. I'm mic'd. Okay, everything's good. Bill Fletterback with Climco. Really glad to be here. I always love being part of the panels, especially with esteemed colleagues. A little bit about Climco. If you were at the previous session, we were fortunate enough to win another Project Developer of the Year award this year with CAR. So we think really highly of CAR and really highly of this NACW conference. And I think this is our 7th year participating. So, why we won that award, when we talk a little bit about Climco for 2 or 3 minutes, is that's the foundation of who Climco is when we started the company, we wanted to identify scalable emission reduction offsets. And we were able to do that. So we have both voluntary reductions as well as compliance grade reductions. I think by our numbers, we were just a hair shy of 15 million tons from the Climate Action Reserve. If you saw their annual report, they were at 103,000. So we're about 14% of the Climate Action Reserve's issuances. We're really proud of that. When I got into this business, I just wanted to create 1 ton. And now we're 15 tons and growing strong. And we're building new plants all the time. So that was our base business, is development. And then naturally we looked to expand. We couldn't just be a developer in this market. We had to learn how to transact. So we became transactional experts in markets. When you're developing or issuing 3 million tons a year, if you can't figure out how to transact them, you're in trouble. And so we did it out of survival. We have some leaders in the room here like Dan Linsky, who helped develop our voluntary sales, where we bring about 5 million plus tons into the voluntary market annually. We also have the compliance part of our business. So transactional assistance is huge for us and our customers. Then also advisory. The markets are complex. Whether or not you're in WCI or you're in a province that is looking at creating their own program in Canada, getting in and advising our customers. And that's a big practice for us in the US, but also a practice for us in Canada. Climco created Climco Canada ULC a little over a year ago. Chelsea Bryant in the front row is our VP of Operations and board member, and is really growing that practice for us. It's really exciting. So those are our services. I can say today, I just want to say we're always thinking about growth. And I'm going to tease the audience a little bit, and there's going to be more to come. But Climco is really excited about launching a new joint venture co-owned by Climco Corporation and the Climate Smart Group to make scalable differences in agriculture in the US, scalable differences. So we're leveraging our expertise along with Climate Smart. Alistair is not here today, unfortunately, but Richard is from Climate Smart. And more to come on the company name and what we're doing, but that's just a little teaser. And I think with that, I'll pass on the baton.
Great. Yep. Well, thank you, Bill. That's every time I hear you talk about Climco, I am always extremely impressed by what you guys do in the market. So congratulations on all your recent achievements and today's awards. Unfortunately, I'm a lawyer. Nobody's perfect, so I don't have as many interesting things to say. My name is Jean-Philippe Brisson. I've been doing, climate markets for about 20 years. I started my career at the World Bank in 1998. It's actually interesting. I did note yesterday at the dinner that my first client ever, who was the head of the carbon finance unit, is actually here in California in San Francisco at a conference today and tomorrow. If you see him, I strongly encourage that you go talk to him. Ken Newcomb created the carbon finance unit of the World Bank in 1998 and raised $2 billion in capital to do offset projects in developing countries. So Ken, in my view, is a pioneer of carbon markets globally, and we are very lucky to have him here at the conference. He will actually speak on a panel tomorrow. But my work is, relates to, focuses on California markets. I work with large emitters and other companies that are subject to the cap and trade program. And over the last 12 months was heavily involved and spent a lot of time on the negotiation of the extension of the cap and trade program, which was adopted by the California legislature last summer. So, which is going to be one of the topics of today's panel. So, pleasure to be here. Lars, thank you so much for moderating this panel, and looking forward to the discussion.
Sounds good. Hi, I'm Jackie Cooley. I'm the lead analyst for North American carbon markets at ICIS. We no longer go by ICIS for obvious reasons. So we won't use that word today at all, hopefully, in this panel. Again, thank you, Lars. Thank you, Bill. Thank you, JP. Thank you, everyone, for being here. And thank you to the Climate Action Reserve for putting on this conference. This is the second time I'm speaking on a carbon-related panel at NACW, and it's a great opportunity. So just quickly, a little bit about ICIS. Again, not ICIS. We're a market intelligence firm covering a lot of different markets: energy markets, petrochemicals, fertilizers, really you name it. So my team, more specifically, we cover carbon markets globally. So that means the WCI program, RGGI, China, the EU ETS, and international offset markets. Just super quick here, we provide price forecasting, all types of fundamental forecasting, policy analysis, market relevant news, just a wide range of things on our online-based portal that you can subscribe to. So,
all right, thank you very much. And I think these brief introductions show we have a well-rounded perspective on these markets. Hopefully they'll provide some value to the audience. With that, maybe if you want to start, Bill, what are the key events or trends that you noticed over the last 12 months in the carbon markets in this region?
I think in the last 12 months, we've been spending an awful lot of time. I think I'll come back to Canada afterwards, correct? But a lot of our time just navigating the complexities of the Canadian markets. A lot of exciting things happening. I want to say Minister Murray, but Glenn Murray just spoke about some of those. I always say following Glenn Murray is always very difficult, especially when I talk about the Canadian piece, because he's one of the few speakers that can actually say fart in public during his presentation and get away with it. But a lot of activity. I think stabilization as a developer, stabilization in the offset pricing. With the certainty to 2030, that's really helped our business. Lack of certainty in some of the offset protocols in the WCI jurisdiction, waiting. So that's been a little difficult. I think some of the Ontario-only landfill protocol, that's really limited. So we're really excited about some of the development with respect to Ontario and Quebec getting together on a Canadian-wide protocol, thinking about mine methane and refrigerants, and refrigerants is a big part of our business. So that's exciting, and what we're excited about is to have both jurisdictions actually approve these. So in the event something crazy happens in Ontario, in the event Ontario pulls out of WCI, we want to make sure that these protocols are at least housed with a province that we believe is more stable in the WCI jurisdiction. So, I think I'm excited to see some of the new protocol development here, Lars. Some of the discussions around grassland and where that's happening. It could be voluntary, it could be one-day compliant. So I think that there's some neat discussions on some more supply. The market needs supply. It's difficult to purchase on the spot market if you're a compliance buyer and you need product. So those are some of my observations, Lars.
JP, you mentioned the extension of the cap and trade program in California. And we'll get into that in just a minute. Anything else that you want to highlight from the last 12 months? Any trends, developments?
No, I mean, that from my perspective, well, I should start by saying I always love it when someone says that Quebec is a more stable province than Ontario, by the way. But leaving that aside for a moment, no, I think for the North American market, for the California market, which is where I spend most of my time working with clients, the extension of cap and trade program is the most significant development in the last 5 years, right? I think it's easy to forget that about 12 months ago we were all here, and we had a cap and trade program that was subject to a legal challenge. There was significant uncertainty as to whether ARB could continue the cap and trade program after 2020, right? Because when you read AB 32 as it then existed, it was really unclear whether the agency had that authority. So there was this uncertainty in the market as to whether people would take position after 2020. And there was also questions of, the market being oversupplied through 2020. And finally, we all knew that the market was under significant attack by the left, We live in two worlds, like the Washington, D.C. world and the California world, right? In Washington, D.C., some groups are denying the existence of climate change, right? And in California, you have oil and gas companies, manufacturers, and industrial companies supporting climate regulation, and you have the left opposing cap and trade programs on the basis that somehow it results in increases of air toxics in disadvantaged communities. So these are fundamentally different situations. And, although it's easy to say now it's great we have cap and trade, et cetera, I will tell you, and we will talk about it a little later, we came that close not to have cap and trade being renewed last summer. I mean, it was that close. So it's great that we were able as a group, and including a lot of people in this room, because I know so many people here work so hard on getting this through. But now the work is in the details and in the implementation of the deal that was negotiated, and that will require a lot of work over the next 12 months.
Jackie, anything you want to add?
Yeah, sure. I don't know if we have access to our slides, but it might be, I have a last year price graph on there, if that's possible. Anyways, it's a graph that shows vintage 2018, December 2018 delivery contract for ICE. So you can really see
the preview of later.
Yeah, so those are keep going. Oh, maybe it's not on there. Anyways, kind of the point is, and as they were saying, the price has reacted to the things that have happened in the last year, especially AB 398. Yeah, there we go.
There you go.
Now go back to that one. That'll be forward-looking. Okay.
There we go.
Yeah, just so people can get a sense of what the price looked like over the last year. Yeah, so again, I mean, one of the big ones is the passage of AB 398. That took a lot of uncertainty out of the market. Allowances were kind of scheduled to be usable for 3 years, and with that extension, we're looking at a 13-year period. So just, the viability of being able to use these long-term was significantly increased in that late July period, and you can see how that kind of influenced the price here in this graph. I don't have a pointer, but it's...
So what happened in March 2017? Why was that increase from 14 to 1450?
I'm not sure. So this is the vintage 2018, December of 2018. So
Oh,
I probably should have put the 17 up for that.
Fine.
But yeah, we'll leave it out there. So the passage of AB 398, I think, is a big one. It kept the price above $15 for the remainder of the year, and I know we'll talk a bit about AB 398 later, and some of the uncertainty in Ontario that kind of pushed it back down below that price level. So that's, kind of the second piece of the puzzle that's been impacting price in the last year. So Ontario saw their fourth auction, and their final solo auction failed to sell out, and that came as a surprise to some people, to some maybe not so much, but really entities started to reassess risk or the political risks in Ontario and the potential that the PCs could withdraw the province from the program. So that would be kind of the second price driver. And then the third, which I think is really impacting the price currently, and especially in the last auction, are the unsold allowances that are returning into auctions that didn't sell out in 2016 and 2017. So auction volumes upwards of 90 million, so much higher than the levels we've seen, with 14 to 16 million roughly returning in each auction now between Q1 2019, assuming things all kind of sell out as scheduled. So that's kind of suppressing the price to some extent right now.
JP, I know you've done some work on it, but is there oversupply of allowances, or is that a artifact of the system and banking?
The oversupply is fake news. People can quote me on that. No, so, you know, I mean, essentially what's happening in Sacramento, for those of you who've been following, I'm sure you will agree. If you don't, let me know. But, you know, there is a fundamental conceptual disagreement between two groups, one very small group and basically everyone else. But there is a small subset of groups and individuals who, are, yelling at the top of their voice and making a lot of noise. And the theory behind that is presented by that group is that reductions in the economy are driven by the high prices, right? So the fact that we have cap and trade is not as important as the fact that there's a price on carbon. And in the view of I hope I'm representing this correctly, but I think I do. In the view of that group, really what's important is having a very, very high price in the market. And for those of you who follow what happened last summer, there was a proposal to amend the cap and trade program, SB 775, which was presented by the pro tem of the Senate and drafted by some individual at Stanford, that basically was establishing a collar with a very high price floor and a very high price ceiling, but a very narrow collar, pushing prices from where they are today all the way up to $150 by 2030. And it was a cap and trade program, but when you really looked at the information closely and looked at the bill, it was just a carbon tax, right? Because the movement between the floor and the ceiling was very limited, and the market was artificially being pushed every year through the legislation to achieve those price levels. The theory behind the bill was that unless prices go to that level, the reductions are not taking place. Whereas the conventional wisdom is that if you have a cap and people emit under the cap, that's what gets you to the reduction level. Then the market establishes the price to get to that level. But what provides the integrity is not the price, it's the cap, right? There's a difference between a tax and a cap and trade program. When you do a tax, you don't know where you're going to end up. You can overshoot or you undershoot because you picked the wrong number. But fundamentally, that group was pushing for a tax and almost got their way through, but that is a discussion that is still happening in Sacramento right now, especially in connection with the price ceiling discussion, right? So the new program, 398, for the first time in a cap and trade program in California, has a hard price ceiling as opposed to a soft allowance price containment reserve. And the price ceiling is not set in the legislation in 398, so ARB needs to establish it over the next couple of months, well, really the next 12 months. And these groups that believe that prices are driving the reduction want that price to be very high, whereas other groups would like that price to be set at a more reasonable level. So we are seeing these discussions that are currently ongoing.
All right. Bill, from a product developer perspective, obviously you would like higher prices. Generally, it's a good thing. But what's your view of the market?
Maybe we can go. Let's go to my offset prices. Actually, as a project developer, I would like offsets to be cost containment for industry.
Yep.
And priced more based on the marginal cost of production, as opposed, nobody prices their product based on our production costs. Everybody prices it based on a differential between where an allowance is being traded at. And the reason being is that the market is still short offsets. So we've always been a proponent of surplus of offsets, even if it impacts the price, because we represent a lot of industry that offsets were really meant to be cost containment. So yeah, I like higher prices, Lars, but I actually like supply. And I think that creates some competitive advantages for companies as well.
And you don't like regulatory uncertainty.
Absolutely.
That would result from prices being too high.
That's correct.
Yeah.
You know, so I think if you look at, and we have a lot more data to support this, but this is just a snapshot of some of the data that Climeco tracks on a daily basis. The blue graph, of course, is the allowance market. And then the other three graphs are going to be different offset products. And just real quick, because I think everybody knows the vernacular, there's a CCO 0 or a golden, no invalidation risk. There's an 8-year invalidation risk product and a 3-year invalidation risk product. So we track each one of those daily. And one of the reasons why we do that is that 80% of everything that we develop, we actually sell as guarantees. So there are times when we don't want to take on additional balance sheet risk, and we will sell as a CCO3 or a 3-year invalidation product. And we like to do that, of course, when there's less spread between a guaranteed product and a CCO3 from a strategy standpoint. But if you look here, historically, what we're seeing here is, I'm always concerned about the CCA to CCO, or the CCA. This is the allowance to the guaranteed spread, the allowance to the 3-year invalidations spread, and the allowance to an 8. But if you start, just look at the averages for a second. You know, on average in this period, if you wanted to buy a guaranteed offset, you were saving $1.51 per compliance unit. So one would say, is that cost containment, is that a savings? You know, you sometimes over $1, if the volume is large enough, customers say, yeah, it's worth it. But when you start to look at the differences between a 3 spread and an 8 spread, it gets more significant. So sometimes what we try to do with our customers is educate them on the availability of these other products, on really understanding what the risks are of invalidation, which are really tail-end risk, and we try to educate our customers on that. But the real difficult thing if you're a compliance buyer is trying to find 8 or 3s. So every time you see this big issuance of 10 million tons, et cetera, most of that's already bought. It's not available to the compliance folks as an 8. It's available to them perhaps as a guarantee because there's larger entities that are consuming that volume and only providing guaranteed products. So if you want to start to optimize your compliance strategy and look at 3s and 8s, you really got to plan. You really got to partner with people because that is really difficult to come by at times in the spot market. And I think the next graph here.
Hey, can I say
yes,
something?
Yeah, please.
Every time I see this graph, I cannot help myself but to think that, and I see some people here with whom I've worked in the CDM market, people should remember that in the CDM market, the spread between an EU allowance and a CER with no invalidation was a 40% spread. And we're here looking at what? It's $1.50 over 15, it's a 10% spread, right? I still don't understand why we have such, So anyway, that's just a note.
And I think the next graph actually presents it in a different way. But if you look on a monthly average, and this is something that it gets me too, because again, cost containment, you really want to see, you know, a larger spread to industry to help them with a lower cost of compliance. This is what we always push for. But on a monthly basis, you'll see the green bar is actually going to be the spread. So that's on a monthly average. You're seeing, to JP's point, August and September, we were at around 11.5% savings. That's it for guaranteed. And then you get some compression. Back in November and December, you were seeing 9% savings. So all of a sudden, you know, that's not that significant. And you know, to JP's point, we're used to significantly higher cost savings in Europe. But we have a lot more data. This is just an 8-month look. So if you're interested in this, Derek Six can provide this. He's on our team here. So
yeah, and one thing, because we do some forward-looking analysis, and if you guys disagree with me, please let me know, but the spread between CCOs and CCAs, we don't see it drastically diverging from where it is today, right? So how much can it really act as a cost containment mechanism? So looking forward, you know, we don't assume that the whole 8% of offsets is used because the price differential just doesn't necessarily make sense for some companies. And then even once we get into the post-2020 period, we don't make assumptions that the entire 4% is used, the entire 6% is used, just because, you know, like you said, it's not acting as a true price containment mechanism in the sense it's not a CER. So.
Yeah. And I would also add, so that's one thing that strikes me. And the second thing that strikes me is the discount baked into the CC08 product, to me, does not reflect the actual risk, right? It's trading, I think they're all trading too high, but the CC08 relative to the golden CCO, as you called it, I think that spread is too wide. Well, it appears to me that it could be too wide. But
yeah, and I think it's good to remember that we've only seen one project being validated so far in 5 years of the program almost. So that was what, 90,000 credits almost, and we have 105 million issued. So, you know, what is the true size of that risk? I know people assess buyer's liability like that, but you know, how risky are these projects?
Yeah, I'd say the risk is more to the developer. ClimbCo went through 2 invalidation risks studies. So we went through the ODS and we went through an ag, and each time we spent 6 figures defending. You know, so from a developer standpoint, it's actually quite painful.
I would agree. Yeah.
Less painful on the buyer.
Lawyers
painful
do
for you.
like invalidation proceeding, just for the record, but most other people don't. Yeah.
JP, just a quick follow-up on the allowances and the unsold allowances. Any risk that those will be removed from the market?
Yes. Yeah. Okay. So the big question now, I think, is the following, right? So we have a price ceiling, a price floor and a price ceiling. The price ceiling needs to be, you know, decided. But then there are 2 speed bumps in 398 between the price floor and the price ceiling. One question is, where will the speed bumps be established? At what level between the floor and the ceiling? And the second question is how big each speed bump is going to be, right? So the speed bumps are supposed to be acting as circuit breakers or moderators, so that prices don't go from the floor to the ceiling and back to the floor quickly as a result of market developments, right? They're supposed to provide a damper, a bump, on the road between the floor and the ceiling. So one question is, where are they going to be? What will be their, and the second question is, what will be their size? In questioning, or in trying to answer the second question, what will be their size, you know, AB 398 provides a minimum of 40 million tons per speed bump. But ARB could decide to put more allowances in the speed bump. The question is, where will those allowances come from? The answer is ARB has a bunch of buckets that it can use in allowances. So there are a number of allowances right now that are unsold in the market that ARB has in its account. There are a number of allowances also in the APCR, you know, account, total of about 250 million allowances total. ARB, their suggestion, like the people who like high prices, right, that I was describing earlier, they are arguing for all of those allowances to become available in the market at the price ceiling, right? If you do that, what essentially you are doing is you're constraining the supply, and you are incentivizing the market to clear at the price ceiling, because all of those allowances are only available at the ceiling. Industry, which I represented during the negotiation of 398, argued for these allowances to come back through option number 1, come back through the regular auction after 2021, right? Because in 2021, there's an expectation that the market will tighten a little bit. So the idea was to pancake, you know, distribute them equally between 2021 and 2030 and offer them in the regular auction and basically let them sell at the auction clearing price, right? Option number 2 is, okay, if the left doesn't want that to happen, right, let's find something else. The something else, option number 2, is to put them in the speed bump, right? But the third option, which is putting them at the price ceiling, would have significant impacts on the markets, right? And then, of course, if the market clear at the price ceiling, right, a very small number of entities may be happy. Like some project developers may be happy short term, some speculators may be happy short term, but everyone needs to ask himself or herself, what is the political acceptability of having an allowance clear at $75? It will have significant impacts throughout the economy in California, and that brings a regulatory risk about the viability of the program. The governor, under AB 32, has the right, through emergency power, to suspend the program at any time. If prices reach those levels, most likely this is what's going to happen. That's why the price ceiling is there, right? It's prevent from prices going too high. And the reason why the speed bumps are there is to prevent prices to get to the price ceiling too quickly. So the next couple of months are really important in making sure that we pick the right levels for the speed bumps and make sure that the overhang in the market of all the unsold allowances, et cetera, don't go to the price ceiling. Because if we do that, we are, in my view, in a political regulatory risk environment where all of you here who have positions in the market could lose all of your money overnight because the governor pulls the plug. And if the governor pulls the plug, well, sorry, my point is it's going to be the next governor. It's not going to be Governor Brown. I trust Governor Brown to make the right decision. But I don't know who's going to be the next governor. And I don't know what his position on the cap and trade program is. And if that situation arises, I don't want to take that risk. So I want these features to be addressed in the regulations by the end of 2018.
Yeah, and I can put some numbers on. I wrote some down that the ARB is looking at. So like you said, 40.6 million as a minimum, and the 2 speed bump tiers. Let's call them speed bumps. I like that. The lowest tier they mentioned would be, at the lowest, $70 and $2015. Set in 2021, so that's roughly $80 or so in 2021 dollars. And then the price ceiling numbers that they're looking at, and a lot of what we heard at the workshop and what I know JP will agree with are high. They're pretty high, and that was 81.90 between that and 150 per ton as a company's internal price of carbon, and that would translate into $92 to like $169 roughly in 2021. So we're talking about much higher levels than what we're currently seeing in the market right now. And we did some analysis with the speed bumps in our last update to our forecast, actually, back in October. But we set these speed bumps at prices that would get triggered in our model. And then we saw how quickly we got through these speed bumps. And with 40.6 million, and again, the lower the price, obviously, the quicker you get through those. So there were some scenarios where that 40.6 million was blown through in 2 quarters. It slowed down the price increase just a tiny bit, but overall it had a very little impact on our overall 2030 price in the end. And it had a very small or minimal impact on just the total undersupply in the market at some period of time. So yeah, I don't make comments to the ARB, but generally speaking, it seems like they might be a little too low in that regard.
You mean too small?
Too small.
Yeah.
Too low value.
All right, I think this provided great insight into the California market, AB 398. I want to turn our attention a little bit, as promised, to the Canadian market. And Bill, if you want to lead us up on kind of what you see there and some of the developments.
Absolutely. When I was listening to Glenn this morning, excuse me, when I got into the space in the European markets, it was at the time when the U.S. didn't ratify the Kyoto. Canada did, and then Canada was the infamous country that pulled out. So I always remember, always thinking about Canada, like what's going on there, right? When we were over in Europe, and now most of our market is North America, defined right now as the U.S. and Canada. So it really how things have changed. We got up into the Canadian market as an entrance point into Alberta, and I think a lot of folks don't necessarily think about some of the other provincial programs unless you have assets there or you're up in those markets. We brought in leadership in Chelsea Bryant from TransCanada to lead our operations about 1.5 years ago, but when we entered that market around 3.5 years ago, it was clear that some of our clients were in a path of disaster with respect to compliance costs, because there was a program called the Specified Gas Emitters Rule that was ratcheting down rapidly. So it was an intensity base. So purists on cap and trade may not think that highly of intensity base, but I actually thought the program was pretty well designed. What was happening was you went from a 12% reduction to a 15% reduction to a 20% reduction in a 3-year period. At that same time, the price of carbon in Alberta went from 15 to 20 to 30. So all of a sudden, some of our big petrochemical clients had an exposure of $1 million, $1.5 million. Seems like a lot for us, but not to them. Now all of a sudden that went to $8 million, $10 million in 3 years. So all of a sudden the cost of carbon in Alberta got really expensive. So the highest price on carbon globally that I'm aware of is actually still in Alberta, which is still at 30 Canadian or around 24 CAD, is what we say. So there's a lot of things going on there. They totally restructured their program. They totally restructured their program starting this year into not an intensity-based, but an output-based program. But last year, I remember, and talking about swipe of the pen risk, that's a program where the optionality of using offsets used to be 100%. Yeah. It was amazing. It was great. Optionality was perfect for industry. The program created a philosophy of hoarding or banking offsets, because if you owned offsets, if you knew the price of carbon was at 15 today, but not that long it was going to be 30, you were going to hold on to them. And you were going to surrender them against your obligation when the price was at 30. That was a natural decision. And that really affected the government of Alberta, because they started doing the modeling and they said, well, wait a second. At the end of 2017, nobody's going to be paying into our clean tech fund, which is your alternative in Alberta. Either buy offsets or buy clean tech fund. So swipe of the pen one day, I remember Chelsea and I dealing with this, they come out and said, we want to restrict offset usage to 30%. Wow, did the market get bearish. So you create a program, people strategize around it, and then if it doesn't work for a government, they think about their budget and they think about a swipe of the pen. Now they've rethought this through a lot of consultation with stakeholders. I'm not going to get into specifics of what it looks like today, but it is different in 18. They've lifted that a little bit, but not significantly. 40%, 50%, we're in that range. But what's happening in Canada is fascinating right now, because there's a pan-Canadian framework that says we have 200 million tons to reduce by 2030. That's a significant lift for the Canadian provinces. So we talk a lot about Ontario and Quebec, but there's so many other moving parts there. And then as of these programs, and I have a chart here that we can send you a report if you're interested, but there's this, Glenn Murray had mentioned this federal backstop. Not a lot of people were paying attention to this federal backstop and these equivalency determinations. Well, as we sit in April, the comments are due by the end of April, and actually your comments, if you have a comment, you can follow it up with data by April 30th, but if you have a comment, I think it's due next week. So you got to get in, and who has to get in and comment on this backstop, and what's the backstop mean? That's the hammer. That's like the federal government in the U.S. saying, if the states don't have programs, here comes the U.S. EPA. And the backstop is scary in the fact that if you start to look at the output-based standards that they're going to define, the baseline is 70% of your process-weighted average. So, in Alberta, if you're in Alberta or in WCI, typically we're used to a 90% of the industry average for your free allocations. Well, this backstop, or what I like to call the hammer, it starts at 70. So if you're not negotiating for your industry, if you're not negotiating for your energy-intensive trade-exposed facilities now, I think you're missing a great opportunity, because I have a fear that this backstop is actually going to affect more provinces than we think. And the backstop could actually affect Ontario. So if Ontario loses their equivalency, if something happens, and Ford, I believe, is the incumbent, or not the incumbent, but the opposing party. But if something happens with that and they pull out of that program, they would lose equivalency. And then all of a sudden the backstop comes in. So even our clients in Ontario are very active with us in commenting on the federal backstop, because they want to make sure their industries are represented and we're getting our points across. There are some benefits to the backstop. You surely can't control where the proceeds go if you're a province, which is very difficult. But some of the benefits are there's some flexibilities around. There's not a definition on the amount of offsets or compliance instruments that you can source outside of paying into the Consolidated Reserve Fund. So there are some options for industries that, maybe it does drive more optionality, more cost containment around the backstop. The backstop's not all bad. It just needs to be negotiated. And I think you're remiss as an industry not to pay attention to this, because everybody thinks it's not going to hit you, but it actually could. And I have on here and hopefully you took a look at this quickly while I was speaking, but I don't cover all the provinces. There are a couple eastern provinces that I've neglected. So if anybody is from some of the smaller provinces, I apologize. But Quebec is obviously represented. So Ontario and Quebec, the equivalency is expected with their programs So the federal backstop would not come in Ontario and Quebec as designed today. We also expect the same in Alberta and British Columbia with their hybrid tax systems. If you go to the next slide, we'll start to actually identify where some of the risks are. So the Made in Manitoba plan just got launched, and I know Climeco is representing a big emitter to design that plan in Manitoba. But what they've said is, we're going to go with the hybrid tax system like Alberta, but you know what, government, we don't think this ratchet up to $50 a ton by 2022 is the right thing for our agricultural community. So we don't know whether or not they're going to lose equivalency based on their 25-ton target, but they risk losing equivalency with the federal backstop. And then you look at New Brunswick, Saskatchewan, you've probably heard, they're pretty vocal. So they're really going to go head-to-head with the government with respect to the backstop. And Nova Scotia equivalency is unclear. So I wanted to highlight, this matrix, and I like to call it the quilt work of Canada. But there's a lot of complexities there and a lot of things to pay attention to. But north of the border, there's a lot of activity, Lars.
Anyone else on the panel have anything to add? That was a pretty thorough overview. All right. Good. One thing I want to ask you about, and certainly if there are questions in the audience, we can get into more detail on Canada, but I wanted to at least touch on one other market that I know you're active in, and I think we heard it in the previous discussion. There was a reference to a deal for, I believe Microsoft did, for solar energy in Virginia. Google just announced how they've reached 100% renewable energy, and you're seeing a lot of these power purchase agreements that corporations are engaging in for renewable energy. And I'd be curious to see if is that being reflected in the voluntary carbon market as well, where you have companies go in and more actively be part of the financing of projects. And is that something you're addressing or seeing, and what's driving it?
Yeah, I love to say this because maybe someday it'll get to President Trump. We want to thank President Trump for his activities of trying to pull out of the Paris Agreement, because what it did for the U.S. Stakeholders is it was a call to action. So I've seen more in the voluntary markets in leaders of companies saying it's the right thing for our shareholders. Sometimes it's pressure up, sometimes it's leadership down. But what we've seen in the voluntary markets has been a skyrocket of activity. I think so. I'd love to say that because I didn't see that one coming. I remember writing the state of affairs for the company after the election and saying, you know what, I think it's going to be okay because I trust the leaders, of industry. And I think we're actually seeing that. So so where we get engaged now more, Lars, and Dan Linsky on our team has been phenomenal at this, is working with big companies that are expanding. They'll come to us and say, hey, we really like this product. Can you go ahead and develop it and finance it? But to help you finance it so we can actually lever debt on some of these deals, we're going to enter into an offtake agreement maybe for the first 2 million tons. Our projects are pretty big. So, so we'll secure enough offtake so we can do an equity debt finance. So we're financing right now several projects for customers that have large demands, customers that say, we're developing an operation here. We need 2 million tons. Do you have 2 million tons, but not from your existing inventory if you have it? We want to be part of a new story. We want our money to go towards a new project being built. So I'm really excited about it. We're working with developers that are looking at carbon neutrality options. It goes all across. I was in a Responsible Business Summit in Brooklyn last week, and Monsanto was a speaker. Well, they set out as a goal for a 6-year commitment to go climate neutral. Not your typical company that you would think is going to go out and communicate such a strong, sustainable goal. And so I'm really excited about it. I think as Climeco, I love this market. I love the voluntary market. I love the complexities of the compliance. But there's nothing like working with people that just really want to do the right thing, and it's exciting. So Lars, I couldn't be more pleased with what I've seen since President Trump took over with respect to voluntary.
There you go.
That's amazing. Well, I didn't expect that one.
Yeah.
All right. Look, do we want to take questions or?
Yeah.
Lars?
Do you have something to add right now?
Well, I will say that I agree with Bill. I have seen a significant rise in the interest on the voluntary side. I think this offset market has not seen as much of that because the way large companies are reducing emission is that they will go to their power emissions first, and the way they address that is through RECs and then long-term PPAs with renewable energy sources. So we've been working on PPAs, but I think now that segment of the voluntary mitigation is being exhausted. And then I think companies are moving into their scope 3 types of emissions. And for scope 3 type of emission, they will require offset. So I think we're going to see more activity from the large companies trying to mitigate their emissions. We're going to see that in the offset market gradually increasing. The other project we've been working on, including with you, Bill, is this concept of achieving carbon neutrality as part of CEQA, the California Environmental Quality Act. So for a number of reasons, there is uncertainty legally in CEQA right now, as a result of which developers of large projects have an incentive to make voluntary commitment to either go carbon neutral or make significant reductions. And that carbon neutrality commitment can be met through the purchase of offsets or direct investment in emission reduction. And you may remember earlier when I start my discussion, and I told you that I was working with Ken Newcomb at the World Bank 20 years ago. I would like to say that Ken is now in the room over there, the tall Australian guy. Ken and I are working on a cook stove project in Africa. We've already built 10,000 stoves, and we are now building 25,000 more stoves. And it is the first time in the history of California that a state-approved program uses international offsets. That has not been picked up in a lot of places, but to me it's a tremendous development. It shows again how California can lead the way, and it meshes very well with the governor's priorities to bring other leaders here in September to have a discussion around international commitments. So I'm very excited about that.
Cool. Well, I think on that note, if we have questions in the audience, you want to raise your hand and Max will find you?
One at a time.
One back there.
Where do you see the value for the voluntary credits going next year?
Well, without getting into pricing here, I would just say that in general, the supply is running out. So a lot of the projects that we see, I think a lot of us have saw, reach their 10-year crediting period. There's two 10-year crediting periods. One certain, the other one is an add-on if you can pass additionality. So we've seen a lot of projects come offline. I don't see a lot of availability of high-quality tons, and you're always going to get a lot of international VCUs that are available in the market. But a lot of our buyers are looking for something that really fits their story, something that's local, perhaps. We all understand climate change is global, but that doesn't matter to the buyer. So sometimes they're wanting local. They're wanting U.S. sourced. I think that there's a big void in Canada for voluntary markets. So I think that we need to have some expansion in Canada with respect to voluntary. But I think prices, we'll see them naturally trend up. Even if you just look at the supply-demand fundamentals, we'll see them trend up. And we are seeing them trend up.
And the purchases that are being made here by corporates, is this generally for longer terms as well? 5, 10 years rather than every year I need to do my sustainability report? Purchase?
Yeah, absolutely. I mean, we tend not to go out 5 or 10 years because we're pretty bullish. But we have gone out 4 years, with offtake agreements. But typically, we won't fix a price beyond that. Maybe we'll index it or we'll do something more strategic. But we don't like to go out that far. And again, it's because we're pretty confident in the markets.
Okay. Do you see it driving new project types? Need for protocols, different standards?
Absolutely. I think we're really excited about what we heard in the grassland management. We know there's a huge struggle in fertilizer management. We represent a lot of fertilizer producers. They want to get behind fertilizer management. So they're looking at the protocols. It's a great way to stiff arm the fertilizer producers by saying the protocol has to be a finite baseline, not based on intensity around crop production. So I think if we're smart and we want to get the big players to the table to talk about fertilizer management, it has to be intensity based. But we're really excited about some of the agricultural protocols. And as far as I'm concerned, if they all stayed in the voluntary markets, I'd be pleased. If they get picked up in the compliance market, it's a bonus. But I am excited to see more development. I think it's a challenge, though, for the Climate Action Reserve, to pick up some really creative projects that may not be scalable enough to warrant the Climate Action Reserve's business model. around protocol development and deployment. So I do see some challenges. I see some of the other registries more flexible sometimes. I hate to say that here, but picking up kind of creative projects because they approach it slightly different. I think the one thing that we think about at ClimeCo, and we always put it on the whiteboard, is think beyond carbon, because the carbon box that we have is really confining. There's a lot of other social benefit projects, and Dan Linsky is involved with ocean plastics now. In developing an ocean plastics credit. That would never fit into a compliance market, but it has incredible value to society. So we talk about co-benefits, but some of the projects that we're looking at are heavy, heavy co-benefit, a little softer on the carbon side. So where do they fit in the market? How do we bring financing to ocean plastics, for instance? So we're excited about some of the societal benefit projects that are happening and hoping that we can get some financing for them.
Any questions in the audience? Last call. There we go.
I think there was a suggestion that there's a fair amount of uncertainty around the unsold allowances, and my understanding, and I sort of wanted Jackie to opine, is that there's basically there are rules about how the allowances are going to roll back in that are in the regulation. It's 25% of the current vintage up for auction at each auction. So do you agree that those rules are set and that CARB isn't really revisiting those in the AB 398 regulation?
Yeah, I mean, I think those rules are pretty set that they're going to return at a 25% maximum. The only thing that could vary how much actually return is a failed auction. So that was one of the concerns that we saw ahead of this last auction, which was 98 million in size, and the potential to have less demand coming from Ontario because their uncertainty was how many allowances could actually be pulled out of the market. So, when we go and look back at the numbers, no matter what, just based on hitting the 24-month rule, there will be, I think it's roughly 40 million that are removed from the market. In Q3 2018 and then again in Q1 2019, I believe. And then the risk that we saw in the last quarter was, well, it doesn't sell out again. How many more to restart that 25% calculation, right? 2 consecutive auctions have to clear. It was potential that number went up from 40 to 65 million. And we were talking about removing 65 million allowances from the market. You're talking about a pretty substantial impact to the market. And then again, I think like JP said, it's a little unclear where those allowances are going to go. If they go into the price ceiling, is that a good suggestion? Is it not? They're also looking at potentially retiring some. So I think that's kind of the direction of that.
I think, thanks for your question, Chris. Actually, I wrote a white paper on this issue, which I'd be happy to send you a copy. It is submitted in the record of the current rulemaking, and it explains why ARB has the discretion to change the 25% rule and the 24-month rule. And I believe that these rules should be looked into as part of the current discussion about how we address some of the issues that have been raised by various individuals, including yourself. I think it's part of the discussion, so I would definitely leave it on the table.
And if I could just follow up, I'd be curious, if you could dust off your crystal balls and what do you think the likelihood is for an undersubscribed auction, due to the Ontario uncertainty?
I personally don't think it's very high. We saw demand, and I don't quote me on this exact number, of 120 million or so, with 98 million allowances being in the auction. And we saw a large number of Ontario entities actually registered for the auction, what we believe are most of the big guys anyway. So I don't think the Ontario uncertainty is really coming into play in that regard. Maybe we can reassess this if Doug Ford gets elected and he actually sets a timeline for them withdrawing from the program, then that might be a different question. But we don't foresee any more unsold allowances being added to that pool.
I think the expectation is that the market is short through 2030, and we had auction failures last year because of the significant uncertainty post 2020, Now that this has been removed, I think there is a view that there are not enough allowances through 2030, that prices are going to rise, and that because of that, I think there's an expectation that all of the auctions going forward will be fully subscribed.
Yep, I agree.
And I think, I mean, Chris, you've raised, I apologize, I addressed Chris here. Chris has authored many papers that provide very good analysis of the situation, so it's great to have you in the audience. My view regarding this question of whether or not the state will meet the 2030 target, which is ultimately, the goal here, is that, this agency, ARB, will have plenty of time to address the market or the program if we feel like we're going to miss the 2030 target. But that assessment should be made closer to 2030, should be made around 2025. It's very difficult in 2018 to predict where we're going to be in 2025 and 2030. So my view, which I present in my paper, is that we should maximize the tools that we have right now to make sure that we have a stable market with slowly increasing prices that provide a long-term signals to investors so that they can take decision to make capital investments in California to reduce emission of greenhouse gases. Program stability and non-volatility and prices increasing through 2030 is what will provide this signal. What we need to protect against are catastrophic movements in prices, swings to the ceiling, swings to the floor that will discourage investments and prompt industry groups and other groups to call for the dismantling of the program. That's what we need to strive for, and these are the challenges that are before us in the current rulemaking, I would argue.
I would just add, I can't forget what happened 2 years ago, which was a black swan event in Reggie. Here they had a new model rule. They tried to adjust it so that it was tighter. And then the CPP got dismantled or set down by the Supreme Courts, and a black swan event happened, and $100 million were lost.
And how many people lost their jobs?
A lot of people lost their jobs.
We went from $8 to $4 in, I think it was seven or 9 days trading.
Nobody could get out of their positions, and we trade some of these markets, so I experienced that. So I never like to overlook events like that. So when I hear that overly confident that the markets will be fully subscribed, I'm not quite as confident, probably because I'm still dealing with the jitters of dealing with that Reggie Black Swan event, being that we traded that market. So I'm a little more cautious.
All right, and I think we're hearing the sounds of lunch, but just maybe at last, is there one or two key things that you're looking for in the coming year? We know about the elections, but each of you, is there some things that you expect in next year, something to look out for? Want to start, Jackie?
I think you got to pay close attention to what's going on at the ARB in regards to AB 398. They have a lot of decisions to make and a lot of interpretation to do, so they'll need to decide what direct environmental benefits means for offsets. We didn't get into that piece, which that opens a whole other can of worms. What the price ceiling is going to look like, how they deal with quote-unquote over-allocation. So they should be giving us a greater sense of what they're actually thinking. They've been doing that over time. So by the end of the year, I think we'll have kind of a sense of certainty on where they're heading in that regard. So just AB 398 very generally.
I agree. The only thing I would add is I think we need to do this, everyone, we need to do this, including you, Chris. We need to do that before the end of 2018. We need to do this under this current governor, because I think if we try to move that into next year, then God knows what's going to happen. Maybe the priority is going to go to another program. So I'd like to be able to circle the wagon before the end of the year.
And I might as well stick north of the border since we covered WCI. Although I think you need to go north of the border.
I should.
I think just we still have the slide up, the equivalency determinations.
Yep.
Under the backstop program, January 2019, these plans are due. So between now and then, there's a lot of activity on equivalency, what's going to happen at the provincial level. So I think over the next year, we'll learn a lot and participate often.
Yep.
All right, well, with that, Jackie, JP, Bill, thank you very much. That's all right.